What's up, everybody? This is Misael Gonzalez. You're watching Wall Street Saturday, a show about God, investing, and stocks. Our show is for educational purposes only. We're not financial advisors. So go ahead and enjoy the show. Share it, like, subscribe, and hit the notification bell to be notified every time a new video comes out. Thank you.
Good morning, everybody. This is Wall Street Saturday. Thank you for joining us once again. Today is May the 7th, and we're going to cover a few things that happened this past week in the market. So stay with us and enjoy the show. My name is Misael Gonzalez.
I'm Joshua Trusty.
And I'm Josh Flores. Before we get too far, man, I was going to pray us into today, man. You know how we do it every week. With your Heavenly Father, we just thank you for another Saturday, another time that we get to come together. We're just grateful to have this friendship. We're grateful to have these opportunities and be in this country where we get to play around and have fun and learn and grow and become more skilled. And we thank you, Lord, and it's in your holy name we pray. Amen.
Amen.
Yeah, cool. Yeah, cool.
What a week it's been.
Yeah, for sure, man. I'm gonna actually share my screen, kind of go over some of the fun that we were having. Y'all can see this S&P right here, right?
Weekend.
Yeah, so this is actually the 5-day here. I'll look at the year to date, which you can see we're still down, and we hit a new low for 2022 that happened this week. We had a little bit of a nice run here for a little bit, but it was all taken away sometime on March the 29th. So a little bit before April, and now it's continuing to go down. Some people are talking about whether or not we're in a recession or not. If you ask me, I think that started January 3rd. But I don't really know what the rules are for that. But this week, just to kind of go over some things, it started out pretty tough. And then we had our minutes from our boy, Jerome Powell. We mentioned that last week. So those who are unfamiliar with the channel, what we talked about last week, we knew that he was speaking on May 3rd and May 4th. And on May 4th, he said something very important in the sense that he said that the Fed is not actively considering increasing interest rates by 75 basis point. So what that really means is 0.75%, increasing it at one time. We do know that they raised it by 0.5% on top of the 25 basis points that were already there. So we know that interest rates are somewhere between 0.75% and 1%. But you can see over here, we had this crazy rally, which ended up being a bull trap there. Those who are unfamiliar with that term, it's just really this quick pop-up of things. Things seem very good, very optimistic, and then very, very shortly after, things just go tumbling down. So luckily, the week just ended 0.18% down for the S&P 500. The NASDAQ might be a little bit of a different story. Yep, you can see it's down 1.5%. So of course, those are a little bit more risky. But overall, did you guys have any thoughts? Or maybe I'm forgetting something that happened this week. Obviously, inflation is just the big thing that's going on still, and the Fed's just still trying to do its thing to fight that. I think that the next numbers that are coming out for that sometime in May the 11th, I think we researched that. So that's just another date to look forward to. But were you going to say something?
Yeah, if you look at the S&P 500 at a 5-year probably look view, so we had the if you look at 2019, the top to the bottom, we had the Christmas December crash. So if you go from the top, if you go there, to down 28, so that's like a 15% drawdown that then we'd recover from. Then you go to the COVID drawdown, right? That happened at the beginning of COVID. That was a bigger 31% drop. But if we go to the one that we are in at the moment, we can see that we're getting close to that 15+% drawdown that we can expect from those 2 or 3 events in the past. So I would say that we are usually when this happens, we do have the 1,000, and I've actually seen the S&P be down 2,000 points in one day. So when I see 1,000 plus points down, it just tells me that there's a lot of information that's going through the market, and the market is trying to price it in. But because there is a lot of information to process within a short period of time, which is a trading session, then things kind of get awry real fast, and that's when you see those kind of price moves happen in the market. But I think it's a good opportunity here in the next few weeks. We'll see the bottom of it, and then after that we'll continue to go up. So yeah, that's the view that I have.
Yeah, I was going to say that it looks like we're actually kind of returning to some of those pre-pandemic levels, really. I mean, I was trying to plot some supports. I don't have that graph up here, but yeah, you can see like the 52-week low. Let me share it again. The 52-week low was 40.56, which I don't think that that was that long ago. I think it's returning back to normal. We were talking a little bit before the show, before this recording, Josh, Misael, and I, just talking about how 2020 and 2021 were really like artificial. I know that's a harsh thing to say. I don't know if that's a thing that I should have brought up here, but everybody was a pro in 2020. Everyone was in 2021. Returns were great, right? But I don't know, Josh. I know that I've been kind of speaking a lot, but I mean, did you have any thoughts? I know that you had a lot of good things.
Yeah, actually, on that, let me share my screen right now, and let me know if you can see it.
Yeah.
So this is like a chart of the PE ratio, like for the overall market, and that is, say, the S&P 500. If you look at something around, let's say the more recent years, like the PE ratio has actually been higher than historically. Historically, it's been like around like 13.34 between like 1900 and then in 1980, whereas these days it tends to be like more around like 22. And so if you look at something like around, let's say like what is it, July of 2021, the PE ratio was actually spiking at that point, and it wasn't really up until I think as of recent, if I go back to the SPY chart for this year, like in like basically December, January, where things actually started to go down. So I think one thing to keep in mind is that we are at an elevated PE ratio that's higher than historical. So right now we're at around like the 25s, like for April of 2022, and that's higher than like even the more recent years, like from the 1980s to like roughly the present. So there's been more of like a premium placed on stocks, and even like when the PE ratio it has like maxed out around like July of 2021, that PE ratio was forced to go down, like I said, like it has in previous years. So I think we're seeing the market kind of like focus more on the fundamentals. So there was like a run up that was not necessarily entirely warranted, and so there's been like a pullback to more historical levels of PE ratios. And so there are two ways basically to reduce that PE ratio. Either you start making more money in your earnings, or you reduce the price. And right now we're seeing a reduction in the price, which certainly is bringing these stocks more towards like their fundamental values. I would say in terms of the outlook, I've also been looking at like a Gerstein-Fisher chart just to kind of like help place where we are right now in the market. Right now, as we had just mentioned with SPY, we're down like about roughly 14% from like the all-time high. So the all-time high was like roughly $480. So I'm off by 2 cents there. But now we're at roughly like $411. So that's a 14% loss. If you look at the historical like market losses, like from 1871 through 2015, there have been several instances where we've crossed that threshold of like negative 10%. We're not like at negative 15% yet. We might get there, but right now we've at least crossed the negative 10% threshold. And so it takes about 5 months. So all of these times are in months here. to hit that threshold of like negative 10%. But after you hit that threshold, it takes about 8 months to hit the bottom. That doesn't necessarily mean that you're going to hit like maybe negative 15%, but for the market to truly bottom out, historically, it's been like about an average of 8 months. And then after that, to recover from the market bottom to like your initial threshold, it's about 27 months. Sorry, like 20 months here from market bottom to the loss threshold, and then from the loss threshold to full recovery from to the original high. So it could take some time for us to get back to where we originally were. But at the very least, since we originally hit that threshold of negative 10% around in, I believe it's February. So if I go back here, it was 10% in, 10% in February. So we might have another 8 months to actually make it to the bottom. Personally, though, there actually can be like some variance in there. So this is just an average. It's not telling you what the average time, or sorry, what the variation is like in all of those like 29 data points. But I think it could be some time before we actually reach the bottom. I'm not saying there's going to be, like maybe like another 10%, but it could take some time as the market consolidates, maybe drifts downward, that we see a true bottom. So that has me like, that doesn't really necessarily have me concerned, because like I try to take the long-term view, but I am a little hesitant to say that we're going to reach the bottom in the near future, like next month or so. I think it could be potentially longer, and if we end up hitting negative 15%, then it might be like 30 months until we reach like that recovery from the loss threshold. So that's where I'm at right now in terms of like my thought process towards where we are historically. I don't think that we're going to hit anything close to what the original like pandemic market like drawdown was, just because like this is mainly just economic policy that's driving it, not necessarily like a global pandemic where we don't know what the future is going to look like. So there's less uncertainty, although still I think that there could be more pain to come in the future.
Yeah, just to kind of bounce off of that too, I mentioned a little bit earlier before that we're going to get the new CPI information around May the 11th. So I imagine that inflation is going to be a little bit worse than what it was in March. So of course, the May date is for the April month. The April release was for the March month. But of course, China, I'm not sure if they still have their lockdowns, but I'm sure that we're going to feel the effects of that 2-week lockdown that they just had. Either they're past it or they're still going through it. But also the next meeting for the Fed is around June the 14th. So I'm still expecting some mess coming over the next couple of months, right? I think that they're still are targeting around 2% by the end of the year. So a lot of interest rate hikes that we will see the rest of this year. But the question that I think that most people are probably wondering, I know we've been talking a lot, sharing a lot of information here. I'm sure that a lot of people are wondering, what do we do? What can be done? And so, of course, we're pretty young. So our initial thought is to buy more, keep buying. Of course, we always try to buy our UPROs. Always try to buy our TQQQs, things like that. But for anybody else out there too, in fact, I can admit that I think that I'm going to hold on to a little bit more cash this time. I think it's important just to make sure that you have your emergency funds, make sure you have that. So just in case of any crazy economic downturn, people tend to get laid off, companies are trying to save some expenses, things like that. And of course, it's just generally wise to have a few months of, emergency fund set up there. But another thing too, for those who are actually in retirement, right? I think that you ought to look for more like utilities, things like that. Maybe some energy stocks that pay high dividends as well. Just something to kind of prevent you from a lot of losses. But I did want to bring up, there's this one fund, a Vanguard fund, that's actually made money so far. It's a mutual fund, so it's a little unsexy to guys like us, right? But it is a mutual fund, but it's made $1 $1 per share. year to date, but it's up 10%, right? 10% is pretty good considering the 13% that is down for the S&P, the 20% that is down for the NASDAQ. So just for some of those that are kind of looking to maybe get something a little less volatile, maybe trying to find something that might work, this might be something to look into. There's a nice article here about it. This is actually where I found it. This is actually something that was posted yesterday. And so, well, last updated today, actually, this morning. But just something interesting to kind of think about for some of those that are kind of looking to not really lose too much money there. You guys have any thoughts? Do you guys have any plans? Any other kind of advice? Was I wrong?
Yeah, I mean, I would say that here at Wall Street Saturday, we tend to move towards like the modern portfolio theory side of things versus risk parity. So modern portfolio theory is just more like, how can I be as best compensated for the risk I'm taking on so basically when I win big, when I lose small. But there's also like a similar approach that focuses more on risk parity. That is to say, minimizing how much money you can lose in a given time period. And I think for older investors who have less time to be investing to recover and such, I think they're going to be focusing more on like risk parity investing in things like the Vanguard fund that you mentioned, because they're going to want to make sure that they're not losing a lot of money towards the end of their investing career. So in that case, I think that might be more appropriate for those investors who have less tolerance or less appetite for risk. But either way, I think there is a single principle that applies to both the modern portfolio theory approach and the risk parity approach, and that is to stay in the market and to stay long and stay green even when times are tough. So whatever you do, keep investing.
What's up, everybody? Thanks for watching Wall Street Saturday. Remember, this is for educational purposes. We're not financial advisors. If you like our videos, go ahead and like and subscribe and hit that notification bell to be notified every time we have a new video out. Thanks for watching.